everyone. Welcome to the Nest Egg Builder Show. I am filling in for Peggy today. And today we have with us Kelly Winglet. Kelly is an accomplished alternative investments expert and the founder of Alternative Wealth Partners, the first private equity firm founded and led by a millennial, openly LGBTQ woman. With over a decade of experience, Kellyanne has raised close to $1 billion in capital for startups, oil and gas companies, manufacturing ventures, real estate, and other key emerging markets. Kelly is also the author of Pitch the Bitch, host of the Wealth Alpha podcast, and a sought after keynote speaker who has shared her expertise in finance, entrepreneurship, and diversity topics or at events like the Women Working in Wealth and We Global Studios Rev Up Summits. When not working, Kellyanne enjoys traveling with her partner, trying out new restaurants, spending time with family, and cuddling with her two big dogs. Welcome to the show, Kelly.
Thank you for having me.
Take it away.
Great. I'm going to kind of keep it high level, give a little bit of my background, and then I'll kind of have a background slide here. And, as people join, they can ask questions. I'm Kelly Ann Winget. I'm the founder of Alternative Wealth Partners. We're a private equity company in Dallas, Texas. We focus mostly on active management of your alternatives portfolio. So most people are working with advisors that are focused on the public equities, life insurance, and kind of your traditional assets, and where we focus solely on alts. Alternative assets are everything outside of stocks, bonds, and cash. So, if you could imagine it, it's an alternative investment, can start as easy as real estate. Most people's first forte into alternative investing is through real estate. That's buying a second property, investing in a multifamily, doing fix and flips, land development. There's lots of different opportunities in real estate. Another big asset class that people have started to really get interested in is the energy space. Now, I'm 5 generations in oil and gas, so this is a space that I really understand, have been a part of my whole life, was born and bred into it. Oil has a couple different ways that you can invest into it as an individual investor, and that's through working interest or mineral rights acquisition, which is just buying the real estate version of oil and gas, the rights to the mineral underground. Where we focus as a firm, Alternative Wealth Partners, is more in the private equity space for operating businesses. We invest at the venture level all the way through buyout, which means that we don't personally, we don't invest as early as idea on a napkin stage. Typically, it's at least a formed idea. They have an idea of who their market is, and they're looking for their first outside capital to grow their business, all the way to I've built a business, I'm a profitable business, but I want out of my business. We'll go in and buy a company like that. I've worked on over 250 individual deals in my career and have raised over $1 billion in private capital. Some of my favorite deals have been in the kind of the industrial space, which is why I focus so heavily on that industry now. I'll share a little slide with you guys right now. Can you guys see this right here?
Yep.
So there's a couple of different things that are going to happen over the next decade as you start to think about diversifying your portfolio. And that's these kind of core things. One, the number changes a lot. You'll hear a $32 trillion wealth transfer. You'll hear $120 trillion wealth transfer. But, we've kind of met in the middle here and have kind of collectively in the industry decided it's $8 trillion is going to transfer over the next decade to the next generation. That's a lot of money. Now, it's not going to be going to every individual. Most of that's going to go to the top 1%, but a lot of that is going to transfer to the Gen X and millennial kind of next generation investor. And that could be through an inheritance or, job creation, business sales, all these different things that are going to happen over the next 10 years. The shift into alternatives is coming from the stress on the banks, right? Used to be really easy and cheap to get capital the last 10 years. Now interest rates are up. There's a lot of market volatility. People are looking for other options, and that ranges from just the individual investor to the actual business owner. If you're paying any attention to the private investment space, you've probably heard things like private credit funds are becoming very popular because you have private capital that wants to lend to businesses or real estate or just private opportunities where the banks won't lend. Banks are becoming less and less risk taker. So when we're talking about trying to achieve a 5, 6, 7, 8% rate of return for the bank, is very difficult. So they're finding less opportunities to lend. So they're sitting on a lot of cash and not able to pay that interest out to the client of the bank. Private capital, however, has a lot more flexibility in the underwriting. So they're able to look at riskier opportunities, knowing that they can lend their capital out at 10, 12, 15%. The business owners will pay it because there's the margin available, the growth available, and work with more patient capital who has a little bit more understanding about how businesses work in order to lend capital out to them. For us as investors in this space, it lends to a really unique opportunity because we can come in as both a debt or an equity partner to these businesses, allowing us to be kind of creative with our deal structure. When we go into an investment opportunity, to, let's say we want to buy one of the deals we're looking at is a metal forging business. This is a metal forging business that's been around for about 75 years. They have a they're a profitable company, not by a lot, but they're also have had no innovation in their manufacturing process in 60 years. So we can go into the company like that, negotiate with the family on both a debt and equity. We can pay them out over time for the equity of their company. And then we can go in and put some efficiencies in, increase the margins of profitability of their business, and then turn around and sell it. The public markets, which I'm assuming why your audience is even involved in this conversation in the first place, is that there's a lot of volatility, especially now when there's a lot of policy change, um, and big personalities in politics. This can really shift public markets because you have large mass of people investing in a very small pool of companies that are all very tied to public opinion. So when somebody who has a big personality makes a big statement, it can really affect the totality of somebody's portfolio if 99% of their wealth is sitting in public markets. So we're seeing a big shift of people thinking about their total portfolio, what kind of risk exposure they have in the public markets, and seeing where else they can put money to work that isn't so exposed to that one particular risk. If you look at the endowment model, so like a Yale endowment, they're almost 90% invested in alternatives. Now, I don't think that an individual should have 90% of their net worth in an alternative investment, but somewhere between 10 and 25%, depending on your risk tolerance, age, and just to build like liquid capital needs, that you should be able to play around in this area with about a quarter of your portfolio. That quarter of the portfolio, when the return metrics in this space range from 3x to 100x, if we're talking about venture, it could really help offset some of that risk, some of that volatility in the other parts of your portfolio. The other part is tax pressure. So there's a controller on this webinar, so I'm sure you're very aware of all the different changing legislation around taxes, especially all of the different tax changes that are being proposed as part of this big, beautiful bill thing. Um, the one thing that investors really need to be thinking about is that there's no future in which taxes will be lower than they are today. We have like $30 trillion we have to figure out how to pay back at some point. And the first place they're going to go is going to be the high net worth individual. And we see a lot of those kind of changes happening inside of this bill proposal. And while it might affect a very small group of people as far as the ultra high net worth, the high net worth individual is going to see some dramatic shifts in how that's going to affect their investment portfolio, their income portfolio, all of these things. And it's actually making it a little bit more difficult for regular people to invest the benefit the same way that corporations can invest for the benefit. So these are kind of big, important things that are happening that people should be thinking about when shifting their portfolio around to include alternatives. Now, I actively manage private equity funds. So we have a pool of funds. They all have a different strategy that it takes into consideration um, your upfront risk mitigation, your cash flow, and then your equity upside. I'm going to pull another slide up here so you can kind of understand what we do. Now, I've spent a very long time in the family office space. And if you aren't familiar with what family offices are, it's essentially the business of your family's estate. So if you have historically $250 million or more in net worth, you have an operating family office. But as resources become more accessible because of AI, because of technology, because of just the flow of information on the internet, people are moving closer to a fractional family office services business where any individual with any type of net worth could have a version of a family office built around them just through tools. And so what I recognized when I left family office in 2020 was that there was not an option for the retail investor to invest like a family office, where we've taken consideration the holistic approach to their investment portfolio. Can we be tax efficient coming in and out of an investment? Can we think about long-term income options? And can we grow sustainably our wealth over time to sustain our family through generations from our investment portfolio? So I created this in a fund structure. So all of our funds, whether it's oil and gas, private equity, tax equity, we're doing a defense roll up right now. So like we manage a lot of different diversified projects, and each one of them follow this model. Can I offset the risk of the investor's capital as quickly as possible in the first 2 years, whether that's through tax credits or tax depreciation? Can I reduce their at-risk capital to zero? And so far, in the first three funds that we've launched and managed, we've been able to get the cost basis of the investor's investment down to zero. So they have no at-risk capital and all of the upside of the fund. We target a cash distribution within the third year. We've been able to do that in all three of our funds to date also, which comes from typically real estate, oil and gas, or an operating business that we buy. There's profit and revenue from there. That revenue gets shared with the investors. Because we're able to take that upfront risk mitigation and that tax and the cash flow incentive, we're able to take bigger risk on the backside of the funds, which is where we hit our 5x multiples on the equity side. There's not a fund out there that's actively managing through this lens. You can see this every single day in a family office because they have a team of people running their investment portfolio like this. We've just been able to package that into an investment experience that's scalable and which allows us to offer this to investors. Now, as an individual investor, you can also set up your own strategy like this. It does take a lot of active management on your part, which some people are not excited about doing. Working with an advisor is difficult. Most people's advisors are not allowed to talk to them about alternative assets unless they have that product under their management in whatever company they have. If they're an independent advisor, they can get more creative, but the due diligence process on these deals can get really cumbersome, which is why most people use outside uh, outside companies to manage their alts portfolio. Um, that's high level, like everything you can kind of do in this space. We like to think about things in a really creative, long-term vision type way. Um, I don't know if we've had enough people join to ask questions or not, but I'm happy to uh, answer any questions that we have so far. We're good? You have a question? Are you raising your hand?
Yes. Go ahead,
Okay,
Ted.
good.
I got a few questions if you'd like.
Sure. Go for it.
Okay. Um, what sort of geographic restrictions do you have on your practice?
We invest all over the place. We don't have uh we're not looking at anywhere specifically. I am, I mean, I like to invest in the United States, so that's where our primary focus is, but we do have assets in places like Jamaica, and we do own a Swiss technology company. So we're not closed-minded to opportunities overseas, but our focus is to either invest in companies that are located here or bring technology or innovation from overseas to the United States.
I was really, well, let's say, more inclined to be interested in, say, geographic restrictions relative to where your customers can be.
Oh, our investors, we can take foreign investors. We have 3 foreign investors currently that are from the UK and Thailand.
So no restrictions in the United States then.
I mean, they've gotta not be a terrorist, so they've gotta pass KYC and AML and, be from NATO-friendly states because we are in the defense world, so, we are very cautious about where the source of the capital is, but if it as long as it's coming from a friendly country, then we don't have any issue with taking that capital.
This is kind of a fun question for you, maybe. But, if you meet somebody who is interested in import export with China,
Mhm.
let's say, how would you identify whether that person is more likely to be an ally of US interests or China interests?
Um, I think it would definitely depend on where that person is coming from, but we do own a free trade zone property, so we're like actively exploring this space of working with import-export partners here in the United States and how to get product into the United States tax-free, or at least working through that cash management tool of the free trade zone. Um, I don't have, like, personally, I don't have any, like, beef with China. I just think of them as an innovation competitor. So, it's like, may the best country win. I think there's worse adversaries out there that's a bigger concern.
The suggestion that I made to people is that if the import export person is more interested in import from China to US, their political interests probably lie more with China than with US.
There's probably some truth to that. We are exploring part of our defense roll up is exploring opportunities to onshore a lot of that manufacturing here again, or just reinvesting in these companies that have been here, that have been maintaining their capacity and not really growing outside of that. They're just servicing a contract they were awarded a million years ago, but have the capacity to like produce a United States screw. Um, my mother used to make a joke long time ago that all China had to do was poison our toothbrushes and we'd all be out of luck. So there's this has been something that's been a part of my narrative for a very long time. And so I think that there are businesses here in the United States that are more than capable of handling a lot of the supply chain problems that we have and like how much we rely on China. I think that we make a lot here. It's going to have to be a collective commitment of both the consumer and the businesses, because there are businesses that make these things here that the consumer's not willing to pay for. Um, and so I actually had this conversation earlier today. It's very similar to how oil and gas and renewables work. The argument for switching to solar and wind only makes sense when oil's at $150 a barrel. When oil's at 50, 45, why bother? Energy's cheap. It's the same thing in this space. Unless tariffs are 300%, no one, the consumer is not going to pay a premium for a US product, even if it's better and just slightly more expensive. So there has to be a shift in that from the consumer's perspective also. as power consumers, we have to slow down our power usage if we want a sustainable transition away from oil. And we're not going to do that. We're just actually making it worse by coming up with AI, right? So there's a lot of kind of nuances to that, but it's something that's very top of mind when we're thinking about these investment opportunities.
Pardon me, I had to push the right buttons here. Excuse me. I first met Peggy through a group called Advanta IRA. Do you have any connections with them?
I think we have one or two clients that use Advanta IRA. We are IRA custodian agnostic, so you could use whatever self-directed IRA that you want to use to invest in the things that we do, or really any alternative. The best things to look for from an IRA custodian is low fees, because they really don't do a lot. So you don't want to overpay for them to just be a custodian of your money. They wire it in and out places and then send you a tax form. And that's about the extent of what they do. And the customer service, you want to be able to get a hold of somebody quickly when you need them, and get, satisfied answers. But there's a lot of them. There's a lot of options out there. We like to work with a handful of them.
I don't recall hearing you describe your management team very much. Can you elaborate on who's in
Sure.
who's in your management team
Let me pull up
and their
their
skill sets?
beautiful faces. So we have a small and mighty team. We'll start with my CFO and advisor, Webb Stickney. He spent over 30 years with the McLean family here in Texas, if you're familiar. He has extensive family office experience and also working on really creative deals. The McLean family own the Houston Astros, so he's worked on some interesting projects, and really heavily involved in like global distribution. So because we're really focused on this industrial space, it was really important for me to find a CFO and a partner who knew how to build these investment opportunities. April Wedding is head of our investor relations. She handles all the relationships with our investors. She comes from more the M&A space in fitness, so she used to scale gyms for sale. She sold her last private gym um, group to Lifetime in 2020 before joining us. Macy Pigman is our CMO and investor relations. She has a deep background in high luxury goods, which is great when it comes to some of our CPG companies that we've been in. She comes from like the Sotheby's, Christie's auction house. Uh, she's really, really, really good at the CPG space. And Bora Lacey, she's a graduate of SMU. She's deeply ingrained here in the network here in Dallas and comes from a deep analytical background. So she provides a lot of insight on the portfolio companies, where we should be looking at placing capital, and then helping a lot of those portfolio companies navigate whatever stage they're in. Because again, we invest in everywhere from startup to buyout. So those startup companies that we invest in don't have the capital to go out and hire really robust teams. So we get to kind of provide a lot of that insight for, equity into their company, and we get to be a part of their success as they grow.
If we were to invest with you, are you helping us invest in individual issues, or do we somehow rather buy into a fund?
Sure. So I manage diversified funds. So right now we have two active funds that are open. That is the AWP Diversity Fund 2. It's a $150 million diversified private equity fund that's invested in critical infrastructure, manufacturing, supply chain solutions, and other ventures. That's going to give you kind of a broad portfolio of private equity. Again, it follows that strategy of risk mitigation, cash flow, and then an equity exit. The other active, and that minimum is $250,000. The other active fund that we have open is our AWP Overmatch Fund. That is our defense roll-up fund. That's going to be more traditional private equity, where we're acquiring operating businesses. The way that we're approaching it is legacy companies that need next gen leadership. These are companies that have $1 to $10 million EBITDA companies in widgets, textiles, and ammunition and energetics. These are all things that are securing our national defense. And that's a $1 million minimum, but it is structured as a opportunity zone because the property that we already own is located in an opportunity zone, which is a real estate designation that allows you to defer your capital gains taxes and then eliminate the capital gains on the appreciation of the investment. So we could probably do a whole nother webinar on opportunity zones, but as things are changing in the political landscape, even part of the big beautiful bill, they're making the in the opportunity zone investment a little bit more lucrative, which is kind of exciting. It allows you, instead of 1031ing your property to death, it allows you to get out of that cycle and take some cash off the table. So you're investing if you have a building, you sold it for $1 million, you had $1 million gain. You could defer that $200,000 federal gains taxes until 2027, which they're trying to extend to 2030. You then have that $1 million invested into, typically it's in real estate. We're using it for private equity because the upside's so much better. It's invested in specifically located businesses or properties. After 10 years, all of the appreciation that's earned on that $1 million in this fund structure is then tax-free. You have a 100% step-up basis when you take your cash out of the fund. And you can actually carry that and keep it invested through 2047. So if we kept finding opportunities and reinvesting, you could essentially, it's like a super Roth. Keep rolling that investment and take it tax-free up to, 20 years. And there's some nuances on the fund management side as far as like how many times you have to invest it and like what your timing is. We can hold capital for 31 months and then invest. If there's an early exit, we can do a distribution, but then reinvest the capital gain within 12 months, and it doesn't remove your exemption. So it's kind of a creative tax strategy. So like our superpower is really thinking about your investment capital in a really tax efficient way that gives you the exposure in the alt space. We are converting to an RIA, which is a registered investment advisor, which will allow us to do a little bit more. Like if you were to bring us an outside deal, we could help you do the due diligence on an outside private alternative that isn't our funds, but we manage our actively managed portfolio. It's a lot easier for people who don't want to go out and manage, 60 different assets to give them the diversification that we can in a pooled fund.
Can you put your contact information into the chat so we can
Sure.
reach you later?
Let me put that in
I'll
there.
put mine in as well.
Do we invest as a fund of funds? No, we do not invest as a fund of funds. We do not invest in other people's funds. The closest that we get is that we hold GP stakes, which are general partner stakes, into other management companies, which allows us to have the GP metrics of somebody else's portfolio instead of coming in as a limited partner. And that's just because we provide other advisory services outside of our capital. Our capital doesn't make sense as a limited partner, makes more sense as a general partner. So like, for example, we just joined 360 Ventures fund at the GP in their advisory circle. So with one investment, we got access to all 250 of their existing portfolio companies, in addition to whatever else they decide to invest in their new $200 million fund at the GP level, which is only split between, I think at the advisory circle, there's 10 of us. So the metrics of return are much greater on the GP side than the LP side. And we only do that because we are experts in this space. So we're allowed to have that kind of exposure. But as far as investing as a limited partner or inside of a syndicate is not something that we don't need to do that. We have direct access to deals. We might co-invest, but we wouldn't be under somebody else's management terms. Let me put my contact information in here.
Thank you.
Can you repeat what you said about mitigating the risk? Part of it is taxes, and part of it is, what is the other part of it besides the tax benefit?
Diversification. So while we're not in one asset class, we can leverage the different risk profiles of the different asset classes that we participate in. So each asset class has its own tax treatment, and then each asset class has its own risk profile. And so when you're in something really conservative like real estate or oil, then it's very predictable as far as the return and tax incentive, which allows us to be a little bit more aggressive in the venture space where things are a little less predictable. You could have a company that was doing really well one day, and when 145% tariffs get put on a company could really change that dynamic. And so having the diversification allows us to change our weight of exposure given what's going on in the market.
I'm still kind of confused by that. Like it sounded like you said there was basically no money at risk.
Correct. So like in Diversity Fund 2, we launched in Q4 of 24. So the first investors that came in got dollar for dollar tax credits. So they invested their tax liability exposure. Somebody owed $250,000 in taxes. They invested $250,000 with us. They don't owe $250,000 in taxes. So the worst I could do is return their money, and they had 100% return because we saved them that tax bill. Now they get all of the upside of the fund with no risk. So it's considered all a gain.
Got it. Thank you.
So we've figured out that your decision is either invest in a future you want to see or pay the tax man and hope
Guarantee your loss.
hope that they make the world a better place with your tax money. I'm a firm believer in, even if you want to do a charitable donation or an impact strategy, that if you're directly investing in things that are making the world a better place, that you should get the incentive of both the tax write-off and the upside. So that's why we structure the things that we do that way.
And everything you have is only for accredited investors, correct?
Correct. Which now means if you got $1 million net worth, a $200,000 plus income, a 65 license, or you're investing over $200,000, you're assumed to be accredited. So we do third-party verification.
So how do you really describe an accredited investor so that the layman can understand it?
If you have $1 million plus net worth, so all of your assets combined outside of your primary residence is $1 million, you're an accredited investor. If you make over $200,000 in income for the last 2 years, you're an accredited investor. If you are a financial professional and hold a Series 65 license, which is a test you can take, you're an accredited investor. And the SEC has just decided that if you're investing over 200,000 into an opportunity, a single opportunity, that you're an accredited investor. Now, our minimums are 250, so I would hope that you're an accredited investor. But we also do third-party verification. It's not required anymore because of this, but for us, we require it.
And my summary to folks is, first of all, you got to be a millionaire. And secondly, you got to be able to afford to lose everything you put into it without it changing your lifestyle.
Yes, that's the best way to put it. As far as our governance work and impact strategy, and if you want to help with due diligence, I don't care if you're an accredited investor, we're not managing your funds. But if you're invested into our funds, then you'll have to be an accredited investor. I think I sent my contact, I sent it to you, Ted, directly, but then I put it on the message for everybody.
I see I have it twice now. And we may need to get better acquainted.
Great. Are you a tax man?
I generally tell my clients that if your focus is on taxes, unless you are a tax accountant, you are probably out of focus. My clientele typically, let's say ideally, is generally in the manufacturing space,
Great.
generically. And professionally, I'm, let's say, part of the fractional CFO space.
It's in high demand.
One would think so.
It should be in high demand.
I would say it should be,
Yes, it
but
should be.
the amusing thing is, who are the two elements in the ordinary business environment who are the most hated?
Your CFO, and I don't know who the other one is.
My observation generally is it's the accounting department and the human resource department,
Oh, yes.
because in both cases, the ordinary expectation is that those groups want you to follow the rules.
Yeah.
And too many businesses operate like these, let's say, unruly children who
Mm-hmm.
don't want to follow the rules.
Oh, yeah.
And so they hate anybody who wants them to follow the rules.
I think that if
That
you have
doesn't mean we can't
understanding
be
of the rules, you can use
creative,
it way.
but you still got to follow the rules.
Yeah, I mean, that's how you play the game.
You don't like the rules, then change it by voting.
Yes.
And what is it? Something like a third of our population votes.
Unfortunately. But if you understand the rules, then you can operate in the private space with or without a government. So I have little faith in either side ever coming together and doing something the right way. So I think the big shift that's going to happen in the next 10 years is that the private capital is just going to do it themselves. And I can see that a lot from not only our own exposure, but the family offices that are getting more active in direct investing instead of going through these large, BlackRock managed funds. When you amass, hundreds of millions or several billions of dollars, you can really just go into a community and plop down an economy. And I think that's what we're going to start to see.
Well, I started my career generally near the beginning of the managed, or let's say of the mutual fund era
Hmm.
back in the 60s. There was some before that, but really started to explode after that. And it's amusing to see how many people have virtually no understanding of why mutual funds were created in the first place.
Mm.
So,
And what would your explanation of that be, Ted, to somebody who is not aware?
well, in the early days of managed money, the the clients were rich folks, and it's fairly expensive to manage a portfolio of, well, even back then, a million or two, something like that. But it was still worthwhile to do it. That's when $1 million was a lot of money, which is not so much anymore. But the advisors started getting questions from their clients about, how can I start an investment program for my kids? And they may have a few thousand to work with, but it costs about as much to manage a $10,000 portfolio as it does to manage $1 million portfolio as a single entity. And so what the advisory firms started to do, let's say, came up with the idea of pooling the small money from the kids and manage the collection as a pool. Most often it would be 2 or 3 or 4 different pools, depending on the investment objectives of that were chosen by the clients. And because if the kids' money was pooled, it cost substantially less per, let's say, per investor to manage the money. And back in the 60s, things were going really, really, really well, and the business exploded. A lot of folks made a lot of money that way.
It's the same thing that's happening in this space now, where everybody wants to be a family office. So they're pooling all these, you see multifamily offices starting every other day, or these big like institutions starting their multifamily office arms. You have people like A16Z, which was a venture firm converting to an RIA so they can manage their clients' wealth in addition to their venture strategy. You have people like CAA, which manages all of the, big celebrities and athletes and stuff. They're speaking in, it's a management company. They've just opened up a wealth management arm. Edward Jones is now offering private client services. So it's people want the product, whether or not mutual funds were the answer or not, but I think that when things become so segregated in this space against, people who have normal net worths and people who are the ultra high net worths, there's an opportunity there to collect wealth and generate it collectively together.
Make it more of a win-win, huh?
I think so.
Collaboration makes everything better.
If the right people are doing it, I think.
Yeah, definitely don't want the wrong players.
BlackRock can only own so much, I feel like,
Yeah, we hope anyways. We're gonna do whatever we can to limit that, right?
Yeah, well, as people become more and more um present in their wealth journeys, I think that you're going to see a shift away from, the big giant funds that you get lost as a number into people wanting to do something more interesting, impactful, directly, relative to things that they care about.
Right.
I've been amused over the years. Let's see, the biggest fraud in American business today is payroll, which I define
W.
as people being paid to do something they don't do.
Yeah.
And it happens most often in large organizations where unproductive folks can find places to hide because the organizations are so big that the size of the organization creates places to hide.
Mm-hmm.
I think that they're trying to work on that, and AI is going to help a lot. One of the things that I like to think about is the opportunity to give people, an AI agent that they can monetize and live vicariously through, right? I think that there's a lot of opportunity for new industries to come out of this, and it will happen very quickly, and it'd be cool to be a part of it as an investor.
Have you ever, speaking of AI, have you ever, let's say, are you old enough to remember a radio talk show in Chicago by the name of Bob Collins?
No.
This was probably 30 years ago when talk shows were just in their infancy. He was the morning man on WGN. And one of his typical responses to a customer call in is the way I describe AI today.
Hmm.
Somebody would call into Bob and he would say, "Bob, can I ask you a question?" And Bob's typical response was, ask me anything you like, and if I don't know the answer, I will make one up for you. There's an awful lot of AI that he performs exactly that way.
Yes.
Now, that doesn't mean I don't like the idea, but probably President Reagan's old line about trust but verify becomes extremely important. If you have no idea what the possible answer to the question that you're asking is, AI can lie to you and mislead you badly.
Oh yeah. I mean it's one of my favorite games to play with my AI actually. Is to ask it a bunch of questions and see what it says. And then be like, no, that's that's not actually that's not actually right. But I think they'll be good task rabbits for a long time. My faith in AI technology is very little at the moment, but I think that because of its how quickly it's growing, it'll be not so long. But again, we've had like, self-flushing toilets and automatic sinks for a real long time, and it still can't figure it out. So I'm waiting for them to do something with AI that's going to actually recognize that there's somebody sitting there or washing their hands. Um, I just wanted to do basic functions first and then try to get more robust. But
It's
again,
interesting to talk to people, young people especially, and ask them about when particular pieces of technology were introduced to our systems.
mhm.
The one for me that's the most fun is when were self-driving vehicles introduced into the transportation system?
I would say trains multiple decades ago would be the first driving vehicle. As far as a car, I don't know, probably 20 years ago.
My grandfather used to tell me stories about taking his date home. This was about 1900 or so. And after he dropped her off, he'd wrap the reins around a cleat on the wagon seat, curl up and go to sleep and wake up in his front yard. That was so horse-drawn vehicles have been self-driving vehicles for thousands of years.
To put a horse brain in a computer. I think there's too many people with too many opinions building the tools for everybody, which will be an unfortunate downfall for AI. But again, it goes back to if the right people are managing the money or the tools, good things will happen. And you just have to be the person who's supporting that.
Let's say the interactive AI tools are only as smart as the data we put into them.
Hmm. When the technology that we invest, I don't invest in AI and I don't invest in crypto. I invest in blockchain technology and I invest in companies that are using AI in their infrastructure, so the data companies that we've invested in the past are really about how accurately and quickly can we collect data, because that's been, like you said, it's the biggest issue is bad data in is bad data out. And I'm a big data fan, so the tech things that we're invested in are really focused on generating, collecting good data, which we can then use for other stuff. That's very valuable. It is the most valuable thing that you can invest in technology wise is data.
Pardon me for monopolizing the questions, but
They were
thank
good
you very
questions.
Does anybody else
much.
have any questions? I don't know who International Partners is. You turn on your camera, we can see who you are. Maybe not.
Do
Okay,
they
do
have
you-
a
So
question?
it's always amusing to me in what is presumed to be a relatively interactive activity like this one is now. Why does somebody sign into it and not turn the camera on if they can?
they just like to listen in and learn, not necessarily by participating, I guess.
It's a lot of information.
But it will be posted on YouTube, so people can always go back and listen in without having to turn their camera on.
Great.
Do you have any more questions, Ted?
Oh, I think that's enough for now.
I
Okay.
think we're going to connect offline, get into deeper things.
Sounds like a plan. Well, thank you so much for coming, Kelly. We really
Thank you for
appreciate
having me.
it.
Thank you.
Welcome. It's really great information. And if anybody was not here to get your information, they can contact Peggy to get your information from her. And then it'll be posted on YouTube shortly for everybody to enjoy.
Great. Thank you so much. Thank you for hosting. Bye.
You have a great day.
Bye.
Bye-bye.
Thank you.